Welcome, my name is James Barber. I'm your Oregon Cash Flow Pro. I just saved somebody $171,000. Let me tell you how I did it. Regularly, I tell you folks, I'm here to help you maximize your cash flow. And it should be fairly obvious that one of the best ways to maximize your cash flow is to reduce your expenses. And I don't know if there's anybody better at doing that when it comes to cash value life insurance than me. This is one example of many. Just know that if you're in the market for a high cash value life insurance design, please come see me. I truly am here to help you. Now, this story starts 4 years ago, at least from my perspective. I met with a potential client via email about 4 years ago, just exchanging some information. They thought they were basically ready to go, kind of knew what they wanted. I sent them what they asked for, and then I didn't hear from them for 4 years. Now, I tell you guys regularly, I am not a salesperson. I don't chase people down for sales. I try to educate people. I give them the information that they need so that they can make a decision. And if they decide to move forward with me, then we move forward. And if they don't, that's fine. Take the information I give you, do with it what you will. I assume people will try to make the best decision for their finances. Now, that's not always the case. Sometimes people need a little bit of a push, and that's where a good salesperson can come in and make a sale that I would never get. Because some people, they need that extra push. They need to be told, okay, it's time to take action, where I just don't like to do that for whatever reason. Thankfully, I have a fairly popular YouTube channel, and we get enough business that I don't have to chase people down in order to be able to feed my family, which allows me to keep designing the policies that I do, like what I'm about to share with you. But this person comes to me 4 years later. This was just a couple of months ago. And they're back looking at the same product that we had talked about 4 years earlier, although the updated product. Well, we re-looked at the whole situation, talked about some different options, and ultimately, I provided him with an updated illustration with the new product and with the figures that he was looking for. Come to find out that they had already been talking with somebody else. They had gotten an illustration from them and begun the application process. In fact, they already got approved. I don't exactly know what caused them to reach back out to me. I don't question those things. I just try to help people the best that I can, and I don't give any grief. If they want to work with me, they'll work with me. If they want to work with somebody else, you can work with somebody else. But they came back, and they really liked the new illustration that I gave them. And let me show you why. This is an older gentleman. He's in his 60s. He's looking to contribute about $400,000 over the course of 5 years. Somewhere around there. Doesn't have to be $400,000, but that was the request. $400,000 over 5 years. Can I do an illustration showing that? Now, come to find out, what you're looking at right here is the illustration that he got approved for from the other agent. Or this is a recreation of that illustration based on the information that I know. From the information I was able to glean, they were putting in $70,000 a year, and the death benefit was $650,000. It's an increasing death benefit, which is how we normally do our designs. And it had the payments going in for 5 years. So this was a total of $350,000 going into the policy. From an expense standpoint, this was not a well-designed policy. They didn't blend in any supplemental term insurance. The supplemental term insurance is non-commissionable insurance. And when you're 66 years old, that makes a big, big impact on target premium and the underlying expenses inside the policy, which I'm about to show you how that impact is. But looking at this, the total after 15 years, the total policy charges $223,000 in expenses. This is the load fee. You can't do anything about this. You just put in less money if you don't want to pay the load fee. It's a one-time cost. The documentation fee, there's nothing you can do about that. But the next two rows, this is where we can design in some savings. Can we save on the cost of insurance? And can we save on the per unit charge? This is where they're going to recoup the commissions that get paid out. And it's not just the commissions, but it's all the money spent in underwriting, paying the underwriter, doing medical exams, ordering medical records, all that good stuff. Any costs that it took that company to sell you that policy. The biggest impact, though, is the commissions. And an easy rule of thumb is to look at the target premium and assume that an agent generally makes 100% of target premium as their first year commission. So the higher the target premium, the higher the commissions. When we're trying to optimize our designs, we want to lower that target premium as much as possible. There's only so much we can do in reducing it. But with any design, we're going to try to reduce it as low as possible in order to save on expenses. Now, the target premium on this policy, $38,000. If I was to sell this policy, I would make a $38,000 commission in that first year. After that, it's a small recurring amount just based on how much money is getting put into the policy. So the biggest impact, though, is that first year's commission. And with this design, $38,000. That's good for the agent, not so good for the cash value in the policy, as you're about to see. Switching over. This is the design that I made. We're not quite putting in the same amount of money. We're putting in a little bit less, but we're using a level death benefit instead of an increasing death benefit. When we've got somebody that's 66 years old, the insurance cost makes a big difference. And if we can squeeze that money in during the first 5 years, utilizing the 7-pay MEC test instead of the guideline annual test, we don't need to use an increasing death benefit for this particular design. So our premium charges are a little bit lower. Not a big deal. He could still try to put in more money later if he wants to get $350 in total. But with this design, he actually can't. He could put a little bit more in year 6, but that's probably not likely to happen. So premium charge is going to end up being less just because we're going to put in a little bit less money. The documentation fee, exactly the same. And the per unit charge, look at this. It was over $6,000 a year because of that big commission. Now it's only $1,000. Our cost of insurance in the first year, $1,000. Over here, almost $7,000 for the cost of insurance. Look at our total policy charges, $223 in the bad design, $51,000 in the good design. That is where that $171,000 in savings comes from my thumbnail. Now, if we go out in this policy even later, the savings continue to be there. So we know that we've saved $171,000 in expenses. Maybe they don't have as much cash growth. Maybe there's something else in here as to why that other agent might design it that way, not just to get a bigger commission. Well, the first thing to know is that our target premium went down to $5,873. I didn't address that in the expense part, but that's why it's not $6,000 a year that the insurance company has to recoup in order to get all that commission back. Now here, we start out with $600,000 in death benefit, and our cash value, $67,000 goes in. We have $57,000 in cash value. The surrender charge in this, with this design, is only $6,000. So most of that cash is available as a line of credit in the first year, just in case. They might not be planning on touching this, but you never know. But because of this design, we don't have very big surrender charges, and most of the cash is available. Where's our cash growth over those 15 years? Projection at 6%, $712,000. Death benefit, $748,000. In the poor design, the death benefit is at $650,000, and the cash value is at $439,000. Now, some of this is a limitation of the design. The client could actually reduce the death benefit lower than $650,000, and that will boost the actual cash growth. But it's not going to be more than $500,000 as part of the projection. Whereas the reduced expense design gets us over $700,000. It's not rocket science, folks. It's just one tweak. It's an agent willing to reduce their commission in order to put more money in the client's pocket. I've been saving people money in these products all day, every day for years. So please don't buy one of these or any cash value life insurance product without meeting with me first. It's free. It's so easy to schedule. Use the Calendly link. You can find a spot that fits your schedule before you make a final decision. And you know I'm not going to pressure you. If you want to work with somebody else, you work with somebody else. I've had people come to me that their family member is an insurance agent. I show them how to design it, knowing I'm not even going to get that sale. But this is how it should be designed in order to better optimize for your cash growth. That's just what we do here. We're always trying to help out. So I hope to hear from some of you soon, and I hope none of you are buying these really expensive policies, because the likelihood of success, while it could happen, it's much, much lower when the expenses are so high. We've really got to get those expenses down to have the best shot at success in these. Final thought before I let you go. There's always talk from IUL haters out there about the expenses of the policies in the later years and how you risk a policy lapse in an IUL. If we manage the expenses, in this case, we don't even need to do anything to manage it because we started out with a level death benefit and the cash value was grown sufficiently to reduce the amount of death benefit that we actually have to pay for. You can see here, in their 80s, we've got over $700,000 in here if we get a 6% growth rate. And the expenses in the policy are less than $2,000 a year through age 86. It's a very, very small percentage. The risk of lapse in this type of a design is almost nothing. It won't lapse unless you take out way too much money and you don't pay anything back and you just mismanage it. That's the only way that this thing lapses, if you have that much money. So a properly funded and a properly managed IUL should have an incredibly high likelihood of success. Now, I have to phrase it that way because I can't guarantee. I don't know what you're going to do with it. You could end up underfunding it. You could end up choosing index options that don't do any growth. You could end up mismanaging it if it's a design that requires making some kind of change in the future. There are a lot of those where we have to, at some point, switch it from an increasing death benefit to a level death benefit in order to reduce the expenses and reduce the amount of death benefit that we're paying for. We do that to optimize for cash growth, but you don't have to do that. That's a decision we make in the future as to what year and how much we want to reduce it. You would do that in consultation with your agent. The most expensive that this policy is showing is at age 91 here. It's a $5,000 cost for insurance. The cash value projection at that age, $1.3 million. That's why I usually say expensive in quotes. It's not expensive in relation to the potential cash value, as long as it was properly funded. And with that, I thank you for joining me. We'll be back again soon. Hit that like button if you appreciate the content we're providing. We'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.